Welcome to Phillip Futures Weekly Market Watch. I'm Shao, FX dealer for Phillip Futures. For this week's episode of Market Watch, I will be focusing on the outlook for gold in Quarter 3. So, we are halfway through Quarter 3 of 2016. Today, we will do a recap on gold for the past quarter and where is it heading towards in the remaining year. After seeing gold moving the uptrend movement since the start of the year, we are finally looking at a downtrend movement for gold. As since the start of the quarter, gold prices have already dipped about 5%, hitting a low of $1,302 per ounce, reaching the key support level at 1,003 since the pre-Brexit period. So what are the factors contributing to the bearish movement of the gold prices? Here, I listed 3 main factors that are driving the gold prices downwards. First, the recent release of Upbeat economic data from America, such as improvement in GDP reports, CPI index, and a strong job data on Quarter 3, these have further justified that US have been proving that their economy are slowly moving towards their expectations of a stronger economy. It's been observed that inflation targets are heading towards their 2% expectations for the year 2016, and US economy are constantly supported by strong labour environment. With much positive data from the US, it also brings lesser appeal towards safe haven assets like gold. Second, another key driver towards the bearish movement of the gold prices would be the recent hawkish comments made by Fed members. As looking back at the recent Jackson Symposium meeting that was held on the end of August, Fed President Yellen made a surprise hawkish speech that the chances of an interest rate hike have increased due to US economy strengthening in the recent months. Following up, Fed Vice Chairman Stanley Fischer and other Fed members have also reaffirmed that the probability of a rate hike is higher due to strong economic conditions. With such hawkish comments from the Fed members, it only results to a stronger dollar and consequently a fall in gold prices, which are inversely correlated. Lastly, as you all know that gold prices are negatively correlated to the dollar, and a rate hike in recent months will mean a stronger dollar. With the recent confidence boost from Fed members and US economic data of an upcoming rate hike, markets have been slowing pricing in the probability of a rate hike, which resulted the dollar to strengthen. From the table, you can see that market have already been pricing in the probability of a rate hike, with September at 21.1%, November at 24.6%, and December at 41.1%. Next, as you can see from the graph, dollar index have strengthened over the past few weeks due to the fact that Fed members are confident for a rate hike by the end of this year, which is backed by a strong US economic growth. With that, it resulted in a slight dip in gold prices, reaching key support level at $1,003 per ounce. Here is the question: will gold break key support level at 1,003? Looking at the 20-year horizon, September has been proven to be the worst month for stocks, since September is usually the month where stock market crashes and the best month for gold. September is usually considered one of the strongest periods due to robust physical demand for gold in Asia in particular. This is the case especially in India, as this is a period where their wedding seasons happens and their physical gold demand soars. This will indicate that gold prices will be well kept above the 1,300 support level, since there will be an increase in market demand for gold. Another factor that will be keeping gold prices above key support level will be largely due to an overall global market uncertainty that are largely contributed by several factors, such as the recent UK referendum where UK chose to leave EU membership, the negative interest rate policy implemented by various central banks, and lastly the upcoming US presidential elections. These factors, I believe, will be significant in affecting the price movement of gold. In conclusion, key support level for gold will still hold at $1,003 per ounce, as global market growth is not promising enough to prove there is a risk-on sentiment. In addition, I believe Fed members will not be increasing their interest rate speculation in the near few months, as there are still uncertainties looming in the financial market, and upcoming presidential elections would be detrimental too. I would suggest short-term speculation would be avoided in favor for a long-term investment diversification for investing in gold. And with that, we have come to the end of this edition of Phillip Futures Market Watch. Thank you for joining me. I'm Shao, and I hope you'll join us again in our next edition of Market Watch. See you!